Hi everyone, I'm here with another BCG Online Case Assessment video. It's been 2.5 years since we launched our last two videos about this assessment, so I thought I would record another one, so I can share with you the latest updates and solve together a brand new BCG Online Case study from Prepmatter's course that reflects the difficulty of the real-life assessment quite well. As usual, if you have any questions, please reach out in the comments or add me on LinkedIn. I get back to every single message. By the way, don't get mixed up with BCG's new Consulting Career Assessment. Yes, I know the names are close to each other, but it is a totally different assessment. I've just created a video about this too. You can find it on our channel. Let's get started. As you might know, the BCG Online Case is an assessment consisting of 8 to 10 questions created in a self-study, interactive format, where you will have 35 minutes to complete the assessment. Some BCG offices send out the invitation after you submit your resume, and those who meet a certain threshold are invited to the interview. In other instances, the BCG Online Case completely replaced one of the live interviews. So there's a chance your first round may include an online case and a real-life case. Regardless, you need to perform well to proceed to the next rounds. The assessment has been getting harder and harder every year. In 2023, when we recorded our two BCG Online Case Assessment videos, we were informed that most cases were qualitative and there were a limited number of quantitative questions. Well, BCG recently changed its online case vendor, and we've seen a noticeable increase in the difficulty of the cases. Many of our students report that the numerical questions take up a long time, and some even found it hard to finish the assessment on time. To reflect this, we've been updating our case library accordingly. As we speak, Prepmatter's BCG Online Case course has 15 interactive cases with heavy emphasis on quantitative questions. We'll solve one of these today, so you can see what to expect when you enroll in our BCG Online Case course, which is the best resource you can find on the market. Also, at the time of this recording, we are running a 50% refund policy. If you don't pass the assessment, we'll refund you half of your money. We've been running this campaign for a few months already, and only about 5% of test takers have asked for a refund, which should tell you something about the success of our BCG Online Case course. Before we begin a full case study, I'd like to address a question I keep receiving. At the start of the real-life assessment, you'll be required to turn on your webcam for proctoring purposes. This is to ensure that you're the one solving this assessment without seeking help from someone else or using external software. I hope this clears things up. A quick legal note, the online case I'll show you was independently created by Prepmatter for educational and training purposes. Alright, today I picked a telco case to walk you through. We wrote this case based on a real-life project my colleagues worked on at BCG. And as I said earlier, the case reflects the real-life assessment difficulty quite well. Feel free to pause the case here and there and see if you're able to get the questions right. You can also solve it yourself in our course first, then check the video to compare your performance. Let me switch to the full screen mode. Great, we'll solve 10 questions in total. Let's get started to see the case prompts and the first question. Our clients are two of the biggest telco operators in South Korea. Last year, their main competitor announced the rollout of 5G to its entire network. Meanwhile, our clients assessed the feasibility of 5G deployment for their system and realized their return would not cover the investment cost. Therefore, they started to discuss a joint investment to save on the network infrastructure and operations cost of 5G. They called us to help them with the assessment of this collective effort. All right, it's a mergers and acquisitions case. We need to pick two clarifying questions before sharing our structure. Okay, let's go over them one by one. What are the latest subscriber growth rates for each operator? It's not that relevant. Let's move on. Who are our clients and what are their market shares in the market? This could be a good question to cover at the start. We don't even know their names or their sizes. Let's get the basics right. Next, do the clients have specific financial or strategic objectives? This question is a must-have. In most M&A cases, we'll need to hit a certain profit margin objective or have budget constraints. Let's select this too. Lastly, do the clients operate in any countries other than South Korea? Based on the case prompts, I understand we'll deal with the South Korean market, so I don't think knowing where else they operate will be relevant for today's case. Great, we got the first question correct. Let's read the answers. It could be helpful for the rest of the case. The clients are two large telco operators, Standalone and MS, with sizes of $20 billion and $15 billion, and market shares of 33% and 25%. They sell fixed and mobile products with established 4G networks countrywide. In terms of the objectives, each operator aims for at least $3 billion additional profit compared to their standalone rollout plan at the end of the first 5 years. Alright, this point is a little tricky. As a side note, I give this case to my trainees in my one-on-one coaching sessions, and many people get tripped up by assuming that as long as the total gains are at least $6 billion, the project is a go. But we need to evaluate each company separately. Alright, let's move to the next question. Which areas of investigation would you focus on when structuring this case? Select 4 options. This is a typical framework question, though we should only pick the most relevant ones. How would the quality of services, such as speed and capacity, change after joint investment? Let's pick this, as better quality may indicate a higher profit potential. Next, how many subscribers does each company have, and what is the geographical distribution of subscribers? This might be relevant, but we already learned their revenues and that they operate countrywide. I won't pick this option. Next, what were the company's marketing budgets for the last 5 years? I wouldn't pick this either. Moving on, what synergies can this joint investment bring, such as procurement, HR, and distribution? This is a really important area to investigate. It will inform the profit uplift calculation later on. Next, what are the expected revenues, costs, and profit outcomes under standalone versus joint scenarios? If I had to pick one option, I'd pick this. We'll most likely deal with this for the rest of the case. Okay, what potential risk does this investment carry? I'll pick this too. In any initial case structure, I always advise including risks. Lastly, how many employees does each company currently have in R&D? This doesn't seem like a relevant point. We made our picks. Let's move on. Great. We chose the right investigation areas. Let's read the information we were given. In terms of products, the investment focuses purely on infrastructure. The quality of the equipment is the same as that in the standalone investment scenario. Hence, there will be no difference in quality, the likes of speed and capacity, between those two scenarios. Let me tell you what this means. Most likely, there won't be a change in the revenues between launching 5G standalone versus in a joint investment scenario. So we can just focus on the costs. Let's read the second bullet point. Regarding synergies, we know that infrastructure operations have various similarities to other network-related areas. Procurement is one of them. We also know that both parties use equipment from the same provider in other parts of their business, such as their data centers and maintenance equipment. Great. This confirms that they will save on costs. Lastly, on the capability side, if the deal happens, then it will be the first network sharing project in the country. Neither party has ever tried such a significant joint investment in the past. Before we move on, if you'd like us to share more content like this, can you do me a favor and like this video or comment below? Also, only 5% of our audience is subscribed to our channel, so please subscribe so you can help us grow our platform. Let's get back to the case. Let's switch to the next question. Which of the data points below are required to run a scenario analysis for both companies and compare the profit after 5 years for individual and joint investment scenarios? Select 5 options. Okay, I'll for sure pick the initial cost of investment. I don't think we'll need to know the depreciation of existing assets. Those assets are not related to the new 5G project. I also wouldn't pick historical network upgrade costs. These are all historical, again not relevant to this 5G partnership. Next, fixed operating costs. Yes, it will be relevant. Advertising and promotion budgets. Since this partnership is on the backend operations, I'm not selecting this. Variable expenses per subscriber. Absolutely, we need to know the variable expenses per subscriber. And knowing the number of subscribers will help us quantify the total variable costs. So to summarize, we need to know the CAPEX and OPEX if you want to quantify the total cost savings, assuming there is no impact on the revenues. So if you only had to pick 4, I'd pick these. But since we can still select the 5th option, I'll go with the revenue projection per subscriber. It will help us quantify the profits of each player standalone and joint investment scenario. Let's look at the visual showing the net gain calculation after 5 years. Number of subscribers times average revenue per user, which will give us the revenue. Summing up fixed and the variable costs will give us the costs or OPEX. Deducting it from the revenues gives us the annual profit. Multiplying it by 5 and deducting the cost of investment gives us the net gain after 5 years. That seems right. Let's continue with the next question. Exhibits 1 and 2 are the projected revenues. and costs for the next 5 years for a standalone, no JV, network building scenario for each company. Based on this information, what are the 5-year profits for each company? Let's go over each exhibit. In the first exhibit, we find the subscriber and revenue per subscriber details for each provider. The title says for both scenarios. It must be because there is no change in the revenues of both clients in the standalone versus joint investment scenario. Let's quickly check the second exhibit too. Here we're looking at the no JV, so a standalone scenario. We can see both clients' CAPEX and OPEX. Okay, I'll get back to these tables, but let's look at the question first. We need to quantify Sadong's net loss in 5 years in the no JV scenario. I'll calculate Sadong's annual profits, then multiply by 5, and deduct the initial investment costs. To calculate the annual profits, let's start with the revenues. Let's see the first exhibit again. Sadong has 50 million users with an annual revenue per subscriber of $750. We're allowed to use a calculator, so let's do the math. 15 million times $750. It's $11.25 billion. Great. Moving on to the costs, let's see the second exhibit once more. Annual fixed cost is 670 million, and annual variable cost is 8.08 billion. So the sum of both should be $8.75 billion. Let's deduct this from the annual revenue of 11.25 billion. We get $2.5 billion. This is Sadong's annual profits. Let's multiply by 5. We arrive at $12.5 billion. Finally, let's subtract the initial investment cost of $12.6 billion. The loss is $100 million. Reading the instructions, if the profit is minus $1 million, we need to type the value without the negative sign. So let's type 100 and add 6 zeros. Perfect. We got it right. Let's follow the same steps and calculate MS's profits. Let's scroll again. MS has 11 million annual subscribers, with each paying $700 a year. Multiplying both should give us $7.7 billion annual revenues. Let's move to the second exhibit. Fixed cost is $450 million, and annual variable cost is $5.55 billion. Both sum up quite nicely. It's $6 billion. That's MS's annual costs. Let's calculate the annual profits. $7.7 billion minus $6 billion. It's $1.7 billion. Multiplying this by 5 will give us $8.5 billion. Finally, let's deduct the initial investment cost of $8.4 billion. The total profit of MS is positive $100 million. Let's type it in. Great, we got this right too. Let's continue reading the text. At the outset of the case, we noted that a standalone 5G rollout is not particularly profitable. That's exactly why our clients are considering a joint investment. The financial figures you calculated earlier confirm this point. Now, let's investigate a profitability for the JV scenario. We can start our calculation with the fixed costs. Fixed costs are the expenses that stay constant regardless of traffic or subscriber numbers. Typical examples include site rental and lease payments, network maintenance, salaries, insurance, property tax, depreciation, and certain utilities. Okay, let's read the fifth question. For this particular project, the key driver for the fixed costs is the number of base stations, and we have the following information on the number of stations in the two scenarios, which are in Exhibit 3 and 4. What is the total annual fixed cost of the JV? Let's look at these two graphs. Exhibit 3. Number of planned base stations by operator in the standalone investment scenario. Sadong was going to build 25.2K, MS was going to build 16.8K base stations. Glancing through the map, there seems to be quite a few overlapping geographies. So, with the joint investment, they must be saving on the number of base stations. Let's look at the next graph. Number of planned base stations in the joint investment scenario. In total, both entities expect to install 28K base stations. And even by looking at the map, we can see fewer base stations. Let's compare the number of base stations in each scenario. In the standalone scenario, we need to sum up 25.2K and 16.8K. which is 42K. And in the joint scenario, it's 28K. Clearly, there is a significant reduction. I suggest we calculate the percentage decline. 42 minus 28 divided by 42. So that's 14 divided by 42, which is 1/3. So the total number of base stations will decline by 1/3. To calculate the total fixed costs in the joint scenario, I suggest we sum the fixed costs we already know for both clients in the standalone scenario, and then take 2/3 of the total. Let's scroll up to see the previous exhibit on the costs. Sadong's fixed cost was $670 million, and MS's fixed cost was $450 million. Let's use a calculator to sum them up. It's $1.12 billion. Now, let's take 2/3 of it. So I'll first multiply by 2, then divide it by 3. It's 2.24 billion. Divided by 3, roughly $746.7 million. Let's type it in. 746,700,000. Great, we got the answer right. As a side note, don't worry too much about rounding. A good rule of thumb is to round up or down to the nearest whole number. You won't be penalized for it. So in this case, you can also write the figure as 747 million. In fact, in the answer sheet, it says approximately 745 million. So I'll continue using this number to ensure consistency. But again, if you end up using 747 million, it won't change the answer. So let's continue investigating the costs for the JV scenario. We know that the parties would split the fixed costs and one-off investment costs equally, while the variable cost would be split based on the amount of data carried. We may need to use this information later on. Considering the following information on costs and data, what is the total 5-year cost for each company in the JV scenario? Okay, the total annual variable cost is $11 billion. The initial investment cost is $16.8 billion. And the Sadong's customers will consume 16.5 petabytes of data, while MS's customers will need 11 petabytes. And 1 petabyte equals 1 million gigabytes. We'll start with Sadong's total cost in the next 5 years. Let's write down each of the 3 cost items: investment, annual fixed, and annual variable costs. If the total investment cost is 16.8 billion and the split is even, then Sadong's share is $8.4 billion. Moving to the annual fixed cost, let's use our previously calculated figure of $745 million. Let's divide it by 2. That would be $372.5 million. Great. Let's move to the annual variable costs. This is a little tricky. While we know the total variable cost, which is $11 billion, we need to calculate how much of this is Sadong's share. Looking at the data amount, Sadong's customers demand 16.5 petabytes, while MS's customers demand 11 petabytes of data. We can calculate their share by dividing 16.5 by the sum of 16.5 and 11, which is 27.5. Let's use the calculator. 16.5 divided by 27.5, we get a really nice ratio of 60%. So Sadong's annual variable cost is 60% of $11 billion, which is $6.6 billion. To calculate the 5-year total costs, we already know the initial investment costs, but we need to multiply each annual fixed and variable cost by 5. Starting with the fixed cost, let's multiply $372.5 million by 5. It's $1.8625 billion. Variable costs are easier to deal with. Multiplying 6.6 billion by 5 will give us 33 billion. Let's sum up all the costs now. Investment cost is 8.4 billion. 5-year fixed cost is 1.8625 billion. And 5-year variable cost is 33 billion. So the total comes down to $43.2625 billion. Let's read the instructions to make sure we don't make a mistake here. Please enter the cost rounded to the nearest billion. For instance, if the answer is $20.3 billion, type 20. In this case, our final answer will be 43. Perfect, we got this correct. Let's follow the same steps and calculate for MS2. As you see, the quantitative questions aren't very straightforward, and we're spending quite some time here already. MS's investment and 5-year fixed cost will be the same as Sadong's. Looking back at our notes from earlier, investment is $8.4 billion and 5-year fixed cost is $1.8625 billion. Regarding the annual variable costs, MS has a share of 40%, so 40% of 11 billion is $4.4 billion. Multiplying this by 5, the total 5-year variable cost is $22 billion. Let's sum them up all together. So we have 8.4 billion, 1.8625 billion, and 22 billion. So it is 32.2625 billion. Since we need to round it to the nearest billion, our answer will be 32. Let's move to the 7th question. Now that we know the cost for each player, let's move on to calculating their profits for the 5-year period. Please note that while the costs differ between scenarios, revenue assumptions are the same. We'll start with Sadong's total 5-year profit. Let's first find what their 5-year revenues were. I couldn't find it in my notes, so we can easily recalculate it. Referring back to Exhibit 1, let's multiply 50 million by $750, which will give us annual revenues. Then multiplying this by 5 will give us the total revenues. Annual revenues are $11.25 billion, and let me multiply by 5. It is $56.25 billion. We calculated their total costs already. Instead of using the rounded figure of $43 billion, I'll use the exact same figure of $43.2625 billion. Again, you can use either number. Your answer will be accepted as correct regardless. So let's do the revenue minus costs. 56.25 billion minus 43.2625 billion. We get 12.9875 billion. In the instructions, it asks us to round it to the nearest million. So let's write 12987. We'll need to do the same for MS2. Again, referring back to Exhibit 1, I'll multiply 11 million by $700 and then by 5. Okay, we get $38.5 billion of revenues in the next 5 years. Let's scroll up to see the total 5-year costs. Okay, it's $32.2625 billion. Again, I'll use the precise number. So the total 5-year profit is 38.5 billion minus 32.2625 billion. It's 6.2375. Since we need to convert it to a million figure, I'll type in 6237. Fantastic, no mistakes so far. Let's read the next question. Now that we have the profits for each player under both scenarios, please calculate the total gain from forming a JV for each player so that we can evaluate against our objective of achieving an additional $3 billion of profit for each player. Starting with Sadong, please enter the total gain from forming a JV. In this case, we'll just compare Sadong's 5-year profits in the joint investment scenario with the standalone scenario. In the joint investment scenario, we just calculated it. Let's go over. It was $12.9875 billion. Let's scroll up to remind ourselves of Sadong's standalone scenario profit as well. Okay, it was minus $100 million. So the net gain is $12.9875 billion plus $100 million. Let me put it in the calculator to play it safe. So that would be $13.0875 billion. Since we need to round the answer to the nearest million, I'll type the answer as 13088. Let's do the same for MS, scrolling up. Their 5-year profit in the joint scenario is $6,237.5 million. And for the standalone scenario, I remember it was $100 million. So the difference is going to be $6,137.5 million. So let's write it down as 6138. Perfect. We got this correct too. Let's read it together. As a result, we can see that both players can benefit significantly from joint investments, and it satisfies both parties' objective of $3 billion of additional profit compared to the standalone scenario. On the other hand, we also need to understand the non-financial factors and potential risks to conclude the case. What potential risks do you think are relevant for this JV? Please select the 3 most relevant options. Alright, let's go through them one by one. Brand reputation risk. Potential damage to either of the brand's image. This is not that relevant. Given that the partnership will be formed on the back end, customers wouldn't even know that those 2 companies are related to each other. Next, dependency risk. Joint investment reduces independence and creates reliance between parties. That's true. In case a decision needs to be made with the supply chain operations, companies won't be able to act on it alone, hence may not be able to make quick decisions. Let's select this. Then we have regulatory risks. Risk of regulatory or legal authorities intervening in the deal. This is a big risk. For example, competition authorities may block the deal if it leads to a monopoly or unfair market power. Next, unbalanced gains. One company may capture significantly more economic benefit than the other. In my opinion, this is the biggest risk. We calculated earlier how much each client will benefit from this deal. Salon gains $13 billion while MS gains $6 billion from this. So MS may renegotiate the terms of this partnership. Finally, we have smartphone sales risk. A potential decline in handset sales could hurt revenues. It has nothing to do with this partnership. So I'll stick to those 3: dependency, regulatory, and unbalanced gains risk. Great, we got it right. Let's see the answer before heading to the final question. Let's take a closer look at what these risks imply for the JV and potential ways to mitigate these risks. Regulatory risk. Since this investment favors 2 of the key players in the market, the other players may object to this cooperation. We may want to understand the antitrust regulations better to see whether there would be any roadblocks. We can also analyze whether there are any examples of it in countries with similar laws. Unbalanced gains. Based on the financial assessment, there are unbalanced economic benefits for both parties. So long as they're expected to make more than twice the profit at the end of the first 5 years, the parties should agree on the compensation mechanism or fair share of the CapEx investment costs. Dependency risk. Despite the cost saving and other qualitative advantages, the joint investment can create a significant interdependency for both parties. In the case that parties want to change any aspect of the infrastructure, then it will highly depend on the approval of the other. Any disagreement between the companies may create significant roadblocks, such as delays in the implementation of the investment. Alright, let's get to the final question. Now, assume you came across the Salon CEO in the hallway at the client side, and he asked you about your analysis and recommendation for the formation of the JV. Please provide your answer to the CEO in 7-8 lines maximum. In the actual assessment, you'll be given 1 minute to prepare your answer. You'll have 1 minute to record your answer, and you'll only have 1 attempt to record your answer. Instead of typing the final recommendation, I'll just deliver it in just under a minute so you can see what a good conclusion may look like. By the way, we have a separate video on how to conclude a case study on our YouTube channel, so feel free to check it out too. Here's my recommendation. We recommend that Salon and MS go ahead with the joint investment to roll out 5G in South Korea for the following reasons. First, they'll be able to incur significant cost synergies with the partnership. Salon and MS are expected to profit around $13 billion and $6 billion respectively in the joint investment scenario, compared to the standalone plan in the next 5 years. This is higher than the initial objective of $3 billion. Beyond the financials, a partnership can help both improve their capabilities and gain a sustainable supply chain advantage over the long term. Having said that, we need to check if the regulations allow for such a partnership at this scale, and we can assist the clients with restructuring the partnership in case of unbalanced financial gains between the parties. Great. In Prepmatter simulation, once you provide your final recommendation, you will have the chance to check our recommended conclusion, as well as how long you've spent on the entire assessment. Hope you've enjoyed this video, and check our website to get access to the simulation. Best of luck with your prep.